So chapter 4, we're moving on. We started with business expenses, income and expenses last chapter, and this is a continuation. So basically what we're looking at here, we're going to start looking at rentals. What schedule do rentals go on again? E, Schedule E. We're going to look at something called passive incomes and losses. We're going to go down the bottom of the front of the 1040, looking at our deductions for AGI in a little bit more detail. We're going to look at different kinds of IRAs, and then IRAs and pensions. So there's a lot of topics in this chapter. Hopefully not too overwhelming. I'll try and flesh everything out. So if you rent, if you buy a piece of property and rent it, your rental income or loss is part of your taxable income. No surprise there. We should probably find a Schedule E so that we can follow along this pretty easily. So how about page 4-47? You probably haven't looked at an E before. When we looked at a C, it was basically a profit and loss for a business, right? A Schedule E is a profit and loss for a rental. And you can see all the items of expense are what you would expect if you had a rental, right? You've got cleaning service, you've got, property management fees, you've got insurance, you've got interest, you've got taxes, you've got repairs, you've got utilities. It's a P&L for a rental. And the bottom line, line 26, is your rental real estate income or loss. And there's going to be a lot of exceptions, but on the general rule, line 26 is going to go and flip one page to now page 4-45, please, on your 1040. That line 26 is going to go where? On line 17 on your 1040. It gets complicated when you get here. I have a condo at Big Sky, and I use it to ski, but I also rent it. I have a cabin at Flathead, and we hang out there, but we also rent it. So it's a vacation home, but it's got personal and rental use. And this is really, really quite common, and I will tell you now with things like VRBO and Airbnb, this is getting extremely common. People are buying properties to do that. In fact, I was reading just in the San Francisco Chronicle on Sunday what's happened to the San Francisco real estate market because of Airbnb. It's just put upward pressure on the prices because people are buying second and third places to rent them, and you get such a top dollar in the city for rentals. It's shifting. It's kind of sad. It's shifting the demographics of San Francisco. Less and less people can afford to live there. There's no yards in San Francisco. Everything's row houses. But what they're doing is they're converting garages. We stayed in a garage with no windows, one entrance and exit out, pitch black in there. I can swear to God, if there had been a fire, we would have just died like rats. No. His boss gave it to us for 4 days. It was a $1,500 value, and it was as wide as this, and from here to there. The 4 of us stayed in there. And it would have gotten $450 a night. Yeah, I mean, that's the kind of stuff we're talking about. There's no yards. Huh? Because it was free.
Oh, I mean, I'm saying if you're being charged that, why wouldn't you?
He gave it to us.
No, I'm saying not you guys,
Yeah.
but people in general. Why would you just stay in a hotel instead of?
Oh, because there's no hotels in San Francisco Center. This is, we walk to Golden Gate Park, we walk to the beach, we walk everywhere. It's all houses, row houses.
Okay.
Yeah. Yeah, Why would anybody stay in the tiny little garage? Okay, so there's 3 categories of how this works, and it's pretty straightforward. The only one that gets a little complicated is number 3. So number 1, and so let me back up. I'm sorry. So when we talk about a vacation house, this is the first slide you come to. Which one of these 3 things is it? Number 1, it's primarily personal. In other words, I rented it out for less than 15 days. We know a ton of people that do this with their homes at Flathead. They rent it out for 2 weeks. You don't have to fill out a Schedule E. You don't have to do any allocation. And then they use their rental money to pay their property taxes at Flathead. Primarily personal.
Well, for instance, I'm upstate New York, Sarasota, Traxie,
Yeah.
6 weeks. And I know guys don't vacate their house, they'll rent it out.
Sure.
They'll rent out for 30, 40 hours.
Sure. Now, though, okay, so then they're going to be either category 2 or 3. So then the question is what they're doing in Saratoga Springs primarily rental use? And this is the math you have to do. If they rented it more than 15 days, yes, they did that. And their personal use doesn't exceed the greater of 14 days or 10% of rental days. You've got a bunch of math to do here. Then it's primarily rental use. So let's work through an example of that.
When it says 15 days and 14 days, is that like for a year?
Yes, annually. So in 2015, I rented out my place in Saratoga Springs for 111 days. And I personally used it for 63 days. No, I'm trying to make a different point. Sorry. I personally used it for 16 days. Your first question is this primarily personal? Look at your screen. Is it primarily personal? Does it fit under category 1?
No, they rented it for more than
They rented it for more than 15 days, so it can't be category 1. Category 2. Did they rent it for more than 15 days? Yes. And did they personally occupy it? What does it say exactly? The greater of 14 days or 10% of rental days? Okay. So they did do more than 15 days of rental. And, okay, what's greater, 14 days? Or what's 10% of rental days? So first you have to compare these 2 numbers. And then just take the greater. And then say, did I use it personally more than that? Yes. So is it category 2? No. What is it? It's got to be category 3. It's dual use. Did my personal use exceed the greater of 14 days or 10% of rental days? Yeah, it did. So I'm category 3, part rental, part personal. Do you want to try another one of these? Because this is the key. You can't even go on to the math on what to do with it until you know which category it is. Well, you're honest about everything if you're going to get audited. No, I didn't say that on tape. People comply with the tax law unless you're somebody that just doesn't.
I just didn't know how they would track it.
The way that you track it is how you track anything, like the business miles on your car, the use of your computer. You've got to have some sort of log. And if you need to prove it, you're going to have to pull out that log. All right, let's try another one. In this example, I've got a place down in Port Aransas, Texas, and we go down there and hang out. It's a little condo on the beach, and I rented it for 163 days. And we personally went down there over spring break for 10 days. Is this category 1? Why not? Rented it more than 15 days. Category 2. What's the first caveat? Did I rent it more than 15 days? Yes. Okay, now do this second bit of math like I showed you. You've got to compare something to something. And then just cross out the one that's the lesser number. Aren't I comparing the greater of 14 or 16 now? The greater of 14 days or 10% of rental days. What's the greater number? Huh? So did I personally occupy it more than 16 days? No, so it's a what? It's a category 2, primarily rental. Okay, last example.
Do these rules apply for no matter where your rental residence is? no matter
Yep.
what state?
Yep. Last example, I used it personally for 100 days, and I rented it for 8. What do I have? Category 1, primarily personal. I just had a little rental on the side.
So what if you like let family use it?
Super good question. Jess asked, what if I let family use it? That counts as personal.
What if they're paying you?
If they're paying you fair market value, then rental.
What if it's like if they were doing, it will be their primary residence, it'll actually be their house they live in.
Yeah.
Except for that 6 weeks, they'll go like stay somewhere else with a relative for 6 weeks, or they'll leave on vacation, they'll rent their house out. Their primary.
Technically, that should go on a Schedule E. You're going to be hard pressed to find anybody that's going to report that, frankly. I mean, it's like you own a house in Salt Lake City during the Olympics and somebody comes in and pays you $3,000 a night. Really? That's going on your 1040? I mean, should it? Absolutely. Is it reportable income? 100%. Maybe because it's a state full of people that are committed to ethically doing the right thing all the time. Maybe it does end up on their tax return. I don't know. There you go. Okay, primarily resident. So you go to that screen, you got to figure out what they are. If they're primarily personal, then really you don't do anything with it. And that's what I'm saying. Like, I mean, it kind of blows me away. I mean, we've got friends on Flathead that rent their house out for $4,500 a week. They do the 14 days, They bring $9,000 cash into their pocket, they pay their property taxes, and they don't have to pay a penny. The rental income is not taxable.
What if it was just left vacant?
No big deal then, there's nothing to account for. Primarily rental. So this was the example of the 63 days personal and the very last one, whatever that was. Help me out with the numbers. What was the example I gave you on that last one? I rented it for 100 and,
Day rental.
No, personally, 108 days.
okay,
It was-
yeah. Category 2, very little personal use. In that case, where it's primarily rental, you've got to allocate the expenses between rental and personal. But if your rental deductions exceed your rental income, you can deduct it against other income, but it's subject to passive loss rules. So basically I think I've got an example next. But what we're talking about here is just like, remember when we did the car and we said how many miles are business divided by how many miles in total? This is your rental portion of your property is how many days did I rent it divided by how many days was it used in total. And that's your rental percentage. Okay, here we go. So let's see, primarily rental. What's this guy? This was a primarily rental. Can you find the percentages for me? This says personal. So when I start talking about my expenses, some of them are going to be rental and some of them are going to be personal. But first we have to figure what percentage is rental and what percentage is personal. What percentage is rental? Did you guys get that? 111 divided by 127 and 16 divided by 127. The first thing you got to figure out, obviously, is how many days total was it occupied. The next question then is, what schedules do these two numbers go on? What schedule does my rental expenses go on? E. What kinds of personal things in a home would I possibly be able to take on my personal tax return? Mortgage interest, not insurance, taxes. Same as when we were dealing with OIH. What personal type expenses ever gets to be deducted that's house related on your tax return? Only your property taxes and your interest. That's it. So if it's primarily rental, what this says right here is just what we practice. You've got to get that percentage. What percentage is rental and what percentage is personal? And that's done by taking rental days divided by total days and personal days divided by total days. When you add up all that 87.4% or whatever that number was of all your rental expenses, if those expenses exceed your income, that shows up as a loss on your Schedule E. And you can take that against your, W-2 that you get for being a nurse. Right? So Who doesn't want a loss that goes against their W-2 income, right? It's a good thing. But, and we're not quite there yet, but just be aware, you're subject to passive loss rules. And you don't know what that is yet, but you've always got to have that in the back of your mind. Because rentals are by nature passive activities. In other words, they're not active, like self-employment income or W-2. That's active income. What's portfolio income? Interest, dividends, capital gains, exactly. This is passive. I have a rental and it sits over there. Even if you actively manage it, it's still considered passive, so it's subject to rules.
Wait, if this is all you do, this is your whole.
Now, okay, if this is all you do, I buy properties and rent them. I've got a girlfriend that does that. She flips them, she refurbs them, she does all sorts of things with them. That's what she does. This all goes on a schedule what? C. And it is subject to FICA because this is her self-employment income. If that's all you do for a living, is you manage property, you flip property, you refurb property, that is your self-employment income. That's a whole different animal.
Don't use the
The
rent
C.
to it,
The C. It's a C.
So what if you're renting out like just a room in your house? Maybe not like a bed and breakfast type setup, but like
That's
just
Airbnb.
kids in the basement that's going to college or something like that.
I would say 99.9% of that isn't reported. People aren't looking to report things like that. And then what I just said, that 12.4% of your mortgage interest in real estate, where does that end up? Right on your Schedule A. Okay, what if it's both? It's a rental and a personal. Same thing, you've got to get that 87.6 and that 12.4. But there's a different rule here, which is your rental deductions can be taken up to the amount of rental income only. What does that sound like? Huh?
Right? You can only take
But it's like the OIH, isn't it, that you can only,
You can't have a loss, you can't have a loss in your own.
but what can take you into a loss situation? Most of you missed that on the test. OIH can't take you into a loss except for if it's what? Mortgage interest and taxes. If you've got a dual-use vacation home, you can't go into a loss unless it's taxes and interest. Why is that, you guys? Why are those two things allowed to take you into a loss with OIH, with vacation homes? Well, you get them anyways on your A. You always get and if you own 5 homes, you get 5 mortgage interest and 5 property tax deductions. That's something some people in Congress are trying to close up too. If you have 5 homes, why do you get to deduct on all of them? Is that okay?
Maybe I inherited all of them.
Okay, here's your example that I'm going to give you about 5-7 minutes to work through this. So I've got a family who owns a ski condo in Alta, Utah. And in the current year, they go down, they go over Christmas, they go over Thanksgiving, they personally use it 25 days. And they rent it out 50 days. And here's what they spend on their condo. They get income of 10 grand, they pay prop taxes of 1,500, mortgage interest of 3 grand, utilities of 2, insurance of 1,500, snow removal of 2,500, and they've got a big depreciation number of 12,000. And my question to you is allocate these amounts between the E and the A. My dad used to say that. He was born in 1913. Oh my God. So what's going to be the first thing you're going to do on this? You better figure out which category you're in. then set up your little E&A. I'll give you about 5 minutes to do this. Okay, so basically what's happening here is your first question is what? Is this category 1, 2, or 3? It's a dual use, isn't it? Did everybody get that it was category 3? Okay. What did you get for your percentages? 66.6 and 33.3, pretty easy, right? So I went through and I put the taxes and interest together. Why did I do that? Because they could bring me into a loss, couldn't they? If I took that against the 10 grand of income, they could take me into a loss. They're not going to, but I could do that. Then I added everything else together except for the depreciation. The utilities, the insurance, and the snow removal. Times 66.6%, there's another 4 grand. So just sort of eyeballing it right now, what do I have? 10,000 of rental income, minus 3,000 here, minus 4,000 there. I've still got how much of income left to absorb? 3. My depreciation was 12,000. I paid a ton for this thing, didn't I? Times 50, 70, that's my 66.6% is 8 grand, but it's limited to 3. How come? Because the only thing that can throw me into a loss on dual use property is what? Taxes and interest. Same as on the OIH. But I don't really feel like most of you got that because I think really only 1 or 2 people got that on the exam. Do you want to ask me questions about that? I don't know how else to really explain it.
So how I figure mine out is I added everything else first to get it to 0, and then the mortgage.
Opposite. Do your taxes and interest first, because what if that number had been 13,000, Jess? Then you're just done, right? Then you're just done with the calculation. What else do you want to ask me about this? Because it really does work just like OIH. Okay, so let me just go back. So what were these percentages again? 66.6 and 33.3, right? And this is everything that goes on your E, and then this is everything that goes, oh shoot, I knew that was going to happen, on your A. But what can go on your A, Jess? That's it.
Okay,
That's
so
it.
just go back to the 45,000.
Yeah, the 4,500 times 33.3% is the 1,500, and that goes to your Schedule A.
So then we would see the 1,500 right? And we use 3,000 on
So
the
basically what I do, let me just show you this. Okay. What I do when I work these is I just go and take all the numbers. You know, I've got utilities equal 1,000, interest equals 8,000, taxes equal 3, and repairs and maintenance equal 4. And my personal use was 19 days, and my rental was 62. What do you do first? You've got to figure out which category you are. Better do that first. It's not category 1. Did I rent it more than 15 days? Did I rent it more than 15 days? Yes. Was my personal use the greater of 14 or 6? 6 being 10% of this. Yep. So yes and yes. So I'm category 2. Not be greater, pardon me. So it's category 3. Category 3. Okay, can I take this down so then? So if you're category 3, what's your next step? Your percentages. And how are we going to write that up here? I'm trying to allocate these to 2. Yep. Yep. Is this 80? What's the percentages? 19 plus 62 is 81. So 1981s is what? 0.235. And this is 0.765. Now, the next question is, which of these items are never going to an A? My what? Yeah, my repairs and maintenance are never going to an A. That's purely personal. And my utilities are never going to an A. That's purely personal. Oh, is it? No.
19 days of personal and 7 rental.
62.
Oh, it's 62. Okay, I'm sorry. My bad.
So what does my Schedule E look like? What's the bottom line on my Schedule E if my rental income was $7,500? What did I say? 7,500? My Schedule E is going to show a loss. Where did I get that? My rental income was 7,500. What do I always take first on dual use? Taxes and interest, let's see what that does. 7,500 minus 6,120 minus 2,295, 915. Can I go any further? I'm done. Scenario 2. My rental income's 9,800. I'm at 0. What do I take first? Interest, 6,120, taxes, 2,295. What's left on your calculator after you take taxes and interest? 1,385. Now I'm going to this whole batch of stuff called other. Everything else other than depreciation. I don't even have depreciation up there. So that's because it must be fully depreciated. So what can I do now? I can only take it to 0. Do I get a carryover? I don't think so. This is all recorded, by the way, too, so please come back and rework these. Because I'm sure you don't get enough of my voice during the class period. Okay, I hate that they even bring this up, but they do, so I got to tell you. So the IRS requires that in dual use, which is that category 3 that we just looked at, that you do just exactly what we did, right? 62 plus 19, your denominator's 81. The tax court has allowed that we use 365 as a denominator. What does that do? It allows more interest and taxes to be pushed to the A and gives more room for other stuff to be deducted on the E. So it's a benefit to the taxpayer. The IRS and tax court have still not resolved this. So if you're an aggressive tax preparer, you do this. I'm not. I do this. Yeah. And I mean, basically, I'll tell anybody, like, I went back and forth with the client on the Sweden thing. She really, really, really wanted her ticket in there, too. And I said, I'll tell you this flat out. I don't go to tax court. I mean, I'm not at the level where I'm going to go represent you at tax court. I don't know how it would turn out in tax court. I'm conservative in nature, not anything else in my life, but in tax prep. Very conservative. And you can do it. We can write your ticket off. That's fine. And there's a 99% chance nothing will ever come.
But you have to explain something stating to understand where you stand.
Oh, absolutely. And I've got my whole email trail with her. Yeah. Oh, yeah. No. I'm a single practitioner without malpractice insurance. So believe me, I cover all my bases.
So when we're doing the calculations for our homework and stuff, do you want us to use the 365 or just the regular denominator?
Regular denominator. I think you might find in the software that they ask you, which one do you want to use? Okay, we just went through this, 3 classifications of income: active, portfolio, and passive. Active is your W-2 and your self-employment income. Portfolio is basically on your D and your B. Passive is just from what we're just learning about, these weird things called limited partnerships, which I'm not going to go into. Rental real estate, REMICs, REITs, all these acronym-laden tax tools that lawyers think up for high-income people. It's passive income. And the IRS doesn't like passive income because basically a lot of it is used to offset, or they don't like passive losses because it's used to offset this stuff. So I'm a doctor with a $400,000 W-2 and I have a bunch of passive losses. So my taxable income is only 50 grand. Okay, the IRS doesn't like them. So what do they say? Starting in the 80s, your basic rule is passive losses may not be deducted in excess of passive gains. So I have a bunch of rental real estate, I have limited partnerships, I have REMICs, I have REITs, and you put it all in a big pool together, and I've got a $2,000 passive gain. Great, that shows up on your tax return. I've got a $10,000 losses in excess of income. Nope. You can only take passive losses up to passive gains, but you can carry them forward, or you can deduct them when the investment is sold. What does this mean for real estate? There's an exception, and this is real estate. Rental property is specifically designated as passive, even if the taxpayer actively manages. So you own a duplex, you take the rental apps, you clean when the tenants leave, you do everything, you actively manage it. And then you do a Schedule E, and it's all rental, there's no personal use. You do a Schedule E, and at the end of the year you have an $8,000 loss. You work as a teacher in the public school system, you've got a $40,000 W-2, no problem. You take that whole loss against your W-2 income. Great. You can take up, the rule is, you can take up to $25,000 of rental loss, except for if your adjusted gross income gets over $100,000. And this is the big deal right here. A lot of people that own investment property are higher income people. So they start to lose their loss once their AGI gets to 100 grand. It's reduced 50 cents for each dollar once your modified AGI gets at 100 grand. So what does that mean?
When you make 150 grand, you don't get a write-off anything.
That's it. That's exactly it. Once your modified adjusted gross income gets to 150 grand, you're done. What does that mean from a mathematical standpoint? Let's do a quick example, and then I feel like I'm kind of losing you guys because there is a lot going on here, and it is 2 hours is a long time to stay focused on this. Any consolation, it's a long time to talk about it too. Okay, so let's do an example where I have a limited partnership gain. So I'm in 2 limited partnerships. Plum Creek was a limited partnership. So I was in Plum Creek, had an $18,000 gain from them. I was in a MetLife limited partnership, lost $29,000 from them. My first question is, how much do I get of my loss? How much of this loss, this $29,000 loss, can I take? I'm limited to gains, right? So I get an $18,000 loss, and I carry forward the other 11. That's pretty straightforward. Next scenario. I've got a bunch of rentals, and my losses total $61,000. My W-2 was 49, and and my Schedule C was 25. So I've got a job, I've got a self-employed gig somewhere, and I got a giant rental loss. By looking at that, I would say I inherited like a couple apartment buildings because I would never have gotten there with that income on my own. How much of my rental loss do I get? Always limited to 25. Right? Always limited to 25. Schedule C, sorry. Okay. Scenario 1, how much do I get in my rental loss? 25 grand. You guys, if I go too fast, you just need to say you're moving too fast to just. Huh? These can be, these losses that you don't take now, you keep a side worksheet on them. When you go to sell the rental property, it's going to decrease your capital gain fund. That's how it works. Quit asking me searing questions. I don't know. I just got back from vacation. Yeah, slow down, you guys. You're blowing me away here. I don't know. I have to look that up. I can't answer that. Huh? I do have it in my PowerPoint? What does my PowerPoint say? I don't think it's in here. Okay, now let's try this example. In this example, I'm single. I own a rental duplex. And I have a loss of 20 grand. So I'm not worried about the 25 already, am I? I'd like to take the whole 20. Can I? Why not? Over. So what's the math? Let's follow the math. My AGI is 118. Once I hit what, I start losing my rental loss. Exactly. So how much is my AGI over that phase-out amount? 18 grand. And I lose 50 cents for every dollar it's over. But here's the kicker. That 9,000, you guys, reduces the capacity loss, not the actual loss. What's the capacity loss? Do I get 16 or do I get 20? 16. Okay, ask me questions. So I've got about 3 people looking like, oh my goodness. This is always the math. 25 minus the number I just came up with. If this number is bigger than 20, you get 20. You're limited to this number. Jess, do you have a question? $25,000 total loss capability must be reduced. Let's try one more of these for wrap up, and then we'll I'll get back to test. Oh, come on, sweetie. start working that while I get the rest of the numbers done, please. Did you guys get category 3? Because category 2, did rental exceed 15 days? Yeah. Did personal use exceed the greater of 14 or 18? Yes. So therefore, it's got to be a category 3. don't allocate the income, do you? Anyone disagree with the numbers? Let me know, has anyone got different numbers? Okay, second wrap up. How much do I get of my rental loss? right? This is AGI. The phase out amount was 100. And I lose half of the capacity to do that. So my actual loss was how much? Yeah. My capacity to take a loss is how much? Bad choice of numbers because we kept coming up with the same 25,000. Sorry, did that confuse y'all? Okay. That was a bad choice of numbers. That was just random that the AGI happened to be 25 grand in excess of. I should have made that a different number. What if my loss had been 9,600 in this example? How much would I take? 9,600. It's just saying this is the most you can take. So for Thursday, I think you should have all your forms printed for assignment number 1, both Montana and federal. And that you should have gone through your source documents and be fairly ready to start actually getting some numbers onto your tax return. I'll lecture for about a half an hour, and then we'll spend the rest of the time working on assignment number 1.